Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at AlgoBot, and in today's video we're studying an expert advisor called Engulfing Pivot Scalp Hedge. This is a pure price action approach. There are no moving averages and no oscillators here. Instead, it's built around three classic ideas: floor pivot levels, engulfing candlestick patterns, and a managed hedge for breakouts that fail. By the end of this video, you'll understand how the strategy spots a breakout, how it scalps the move, and how it responds when a break turns out to be false. Let's get started. So what exactly does this expert advisor do? At its core, Engulfing Pivot Scalp Hedge is a short-term, price action strategy. It deliberately uses no technical indicators. There are no moving averages, no relative strength index, no average true range, and no bands. Instead, it relies on two of the oldest and most widely watched tools in intraday trading: floor pivot levels and engulfing candlestick patterns. The idea behind floor pivots is that they are the reference lines that countless intraday desks mark on their charts each session. There's the central pivot, the first resistance, and the first support. Because so many participants watch them, a decisive close through one of these levels can mark the moment the level gives way and order flow shifts. The strategy combines that with the engulfing pattern, which adds a conviction filter. It only acts when a candle's body fully overwhelms the previous candle's body, suggesting genuine commitment rather than a brief test of the level. This expert advisor is designed for liquid, breakout-prone markets. Think major foreign exchange pairs like euro-dollar or pound-dollar, or gold against the dollar. It typically runs on intraday time frames from 5 minutes up to 30 minutes. Where pivot breaks and false breaks alternate throughout the trading day. It's a scalping style, aiming to capture a quick thrust off a level rather than holding for hours. In terms of who might study this approach, it leans toward traders interested in short-term, rules-based breakout systems, and in how a strategy can manage a failed signal rather than simply accepting the loss. As always, this is shared purely for educational purposes. It is not a recommendation, and like every trading approach, it carries real risk, including the risk of loss. No strategy performs well in all market conditions. Let's walk through the mechanics step by step. First, the levels. On every newly closed bar, the strategy looks back over a set number of candles, 20 by default, set by the pivot lookback parameter. It records the highest high, the lowest low, and the closing price of that block. From these, it computes the classic floor pivots: the central pivot, resistance 1, and support 1. The distance between resistance 1 and support 1 becomes the pivot range, and almost every other distance in the system is measured as a fraction of that range. That's a clever design choice, because it means the strategy scales automatically to any symbol or time frame without hard-coded pip values. Now the entries. The strategy only looks for a new trade when it is completely flat. For a long, it waits for a bullish engulfing candle, a bar whose body fully covers the previous bar's body, and that candle must close cleanly above resistance 1, having come up from below. The engulfing requirement filters out weak pokes through the level. The body has to be at least the EngulfFactor multiple of the prior body, which defaults to 1.1. When both conditions are met, the strategy signals a buy. The short side is the exact mirror, a bearish engulfing candle that closes cleanly below support 1. For risk, the take profit is the quick scalp, a target set a fraction of the range beyond the entry, controlled by target fraction, which defaults to 1/2 of the range. The base stop loss is placed deliberately beyond the hedge trigger, so the hedge always has a chance to act first. Here's the signature mechanic. While the base trade is open, the strategy watches the broken level. If price travels back through that level by the fail fraction of the range, a sign the breakout is failing, it opens an opposite hedge leg. The hedge rides the snapback in the new direction and offsets the losing base trade. The hedge size can be larger than the base, set by the hedge volume factor. Finally, exits are governed by BasketMoney management. Once any exposure is open, the strategy sums the net floating profit and loss. If that figure reaches the basket take profit amount, it closes everything. If it falls to the negative basket stop amount, it flattens everything as a hard ceiling. Remember, trading always involves risk, and losses are a normal part of the process. Let's look at the actual MetaTrader code. At the top, we have the input parameters, the dials you can adjust in the strategy tester. Pivot lookback sets how many bars build the pivots. EngulfFactor controls how dominant the engulfing body must be. Break fraction is the clean break margin past the pivot, and target fraction sizes the scalp target. Fail fraction defines how far price must move back through the level to count as a false break. Stop fraction pads the base stop, and hedge volume factor sizes the hedge. BasketTpMoney and BasketSlMoney are the money targets for the whole basket, and lots is the base trade size. Now the long block. The Boolean breakup checks two things: that the prior close was at or below resistance 1, and that the current close is above resistance 1 plus the break margin. When that's true and a bullish engulfing has formed, the code sets the level to resistance 1, computes the fail trigger just below it, places the stop beyond that trigger, and sets the take profit a target fraction above the ask. It then calls open base, which places the trade dot by order you see at the bottom. The short block is the mirror image. The Boolean breakdown checks that the prior close was at or above support 1, and the current close is below support 1 minus the margin. With a bearish engulfing present, the level becomes support 1, the fail trigger sits just above it, the stop sits beyond that, and the take profit is set a target fraction below the bid. Open base then places the trade dot sell order. Notice both sides share the same structure, perfectly symmetrical, just flipped in direction. Now let's bring it to life on the chart. On screen you can see 3 dashed horizontal lines. These are the floor pivots the strategy calculates. The upper red line is the resistance pivot, R1, at 1.0880. The middle gray line is the central pivot, PP, at 1.0850. And the lower green line is the support pivot, S1, at 1.0820. Watch how price interacts with these levels. In the opening candles, price is drifting just under the central pivot, coiling beneath resistance. Notice it isn't breaking anything yet. The strategy stays flat, simply measuring the range. As the next few bars print, buyers start to lift price up toward the resistance pivot at 1.0880. Then we get a small bearish candle that stalls right under resistance. This little down bar is important because it becomes the candle that the next bar must engulf. Here's the key moment. The following candle opens near the prior close, then pushes upward, its body completely covering the previous bar, and it closes cleanly above the resistance pivot. That's a bullish engulfing breakout, the exact condition the strategy waits for. Resistance has given way with conviction, not a one-tick poke, and you can see the buy entry marker appear on this candle. The stop is tucked well below, beyond the level where a hedge would activate, and the take profit sits a fraction of the pivot range above entry. Now follow the move. The next candle extends higher, then another continues the run, and price reaches the take profit marker above. The quick scalp is complete. The strategy closes the trade at its target and returns to flat. That's the long sequence. Approach, engulfing breakout above resistance, scalp to target. Now watch the market roll over for the mirror trade. Price turns down from the highs, slips back through the central pivot at 1.0850, and starts heading toward the support pivot at 1.0820. As it nears support, we get a small bullish candle, a brief bounce higher. Just like before, this is the bar that the next candle must engulf. Only this time we are looking for the bearish version. The very next candle opens above the prior close, then sells off sharply, its body swallowing the small bounce, and it closes cleanly below the support pivot. That's a bearish engulfing breakdown. Support has broken from above. The sell entry marker prints on this candle. The stop sits above the level, beyond the hedge trigger, and the take profit is set a fraction of the range below entry. From there, price slides lower. The next bar continues down, and the one after reaches the take profit marker beneath support. The short scalp is complete. Approach, engulfing breakdown below support, scalp to target, the perfect mirror of the long. Now, a quick word on what isn't drawn here, but matters just as much. In both of these examples, the break held and ran straight to target. In real markets, that doesn't always happen. Sometimes price closes through the level, traps the breakout crowd, and snaps back into the range. That's precisely when the hedge mechanic we discussed earlier steps in. If price travels back through the broken level by the fail fraction, the strategy opens an opposite leg to ride the snapback, and the basket money management takes over the exit. The reward to risk thinking here is straightforward. The scalp target is sized against a structural stop, and the hedge exists to manage the times a clean break turns into a false one. Always remember, no setup works every time, and every trade carries real risk. And that brings us to the end of our breakdown of the Engulfing Pivot Scalp Hedge Expert Advisor. We covered how it builds floor pivots from recent price, how a bullish engulfing above resistance 1 signals a long, and a bearish engulfing below support 1 signals a short, how it scalps toward a range-based target, and how its hedge and basket money management handle a breakout that fails. Everything we discussed today is for educational purposes only. It is not financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.